Welcome to 5 Barrel Factors, the channel where we break down the 5 key forces shaping global crude oil prices. During week 44 of 2025, ICE December Brent crude rose by 2.6% week over week, climbing from $63.40 to $65 per barrel. Here are 5 key factors that influenced crude oil prices over the past week. First, port fees truce turbocharge. A breakthrough in US-China trade tensions lifted shipping sentiment this week. Both countries agreed to pause port fees on vessels tied to each other's fleets for 1 year, avoiding escalation under Section 301. Beijing will suspend retaliatory measures after Washington shelves its investigation. Freight relief is already visible. A medium-range tanker on the Yosa-Singapore route fixed at $575,000 for November 1st gasoline loading, down $10,000 day on day. The deal will cut extra premiums on China discharge clauses and ease logistics for refined products and naphtha. Additionally, China will lower retaliatory tariffs on U.S. crude from 20% to 10%, though analysts say this will not reopen the U.S. to China crude arbitrage. This move stimulates capacity, reduces tanker costs, and supports crude upside. Second, Lukoil's global shakeup. Russia's second-largest oil producer, Lukoil, accepted an offer from Gunvor to acquire its international portfolio after U.S. sanctions on October 22. These assets include nearly 500,000 barrels per day of upstream production, primarily Iraq's West Qurna 2, and 400,000 barrels per day of refining capacity in Bulgaria, Romania, and the Netherlands. Lukoil also controls about 2,000 retail stations in Central and Eastern Europe. With OPEC approval pending before November 21, Gunvor's entry provides working capital, non-Russian crude, and logistical certainty, minimizing operational risk for European refining systems. Experts expect stable output but greater flexibility to replace sanctioned molecules. A smooth transition prevents supply disruption, supporting refinery runs and tightening seaborne crude balances. Third, Iraq's output tightrope. Iraq reaffirmed crude capacity at 5.5 million barrels per day, yet remains bound by its OPEC Plus quota of 4.431 million barrels per day through 2026, plus voluntary cuts that kept September production at 3.25 million barrels per day. A fire on October 26 at the Zubair 1 depot, linked to 500,000 barrels per day Zubair field flows, reduced output temporarily and could disrupt exports for several days, though officials cited limited impact. Basra medium barrels are key for refiners across Asia and Europe, and SOMO plans to reallocate stored volumes to maintain loadings. Even short-term outages in southern Iraq, the world's third-largest exporter, tighten sour crude supply and strengthen prompt differentials. Reduced near-term flows and quota discipline lean bullish for Brent. Fourth, demand roars on. Saudi Aramco expects global crude demand to grow from 1.1 to 1.4 barrels per day in 2026, citing strong fundamentals and rising use in the global south. Current global hydrocarbon consumption stands near 345 million barrels per day, up from 195 million 10 years ago. Additionally, Wood Mackenzie now forecasts a peak at 108 million barrels per day in 2032, 2 years later than earlier estimates, due to AI-driven power demand, petrochemical investment, and slower than planned renewable deployment. In China, 2025 demand sits at 16 million barrels per day, but long-term decline is cushioned by chemicals growth. India, Southeast Asia, and Africa remain key drivers. A slower energy transition, continued fossil infrastructure spending, and geopolitical risk keep barrels in demand, strongly bullish for crude prices. Fifth, German refinery reprieve. The U.S. Treasury granted a 6-month general license to Rosneft Deutschland, protecting its stakes in the Schwedt, Miro, and Bayern oil refineries from sanctions until April 29. Together they form a critical supply chain for German and Central European fuel markets. The exemption preserves payment access and avoids disruption after trusteeship began in 2022. German authorities still push for asset transfer, with expropriation legally complex and contested. Market focus centers on uninterrupted diesel and jet output in the EU's tight refining system, especially into winter. By ensuring product continuity, the waiver stabilizes European supply, softens risk premiums, and is neutral to slightly bearish for crude. Thank you for watching 5 Barrel Factors. Stay with us for clear, concise insights into the forces driving global energy markets. Don't forget to subscribe and continue following the channel for daily updates.